reversal trades have a very, very high risk to reward, but they have low probability of actually finding that area. And one of my mentors, one of the best traders I know, told me once that the best trades are most likely not going to happen from the first time, right? You're probably going to have to try it once, twice, maybe 3 times, but you don't want to overdo it. So trying to catch knives like yesterday, we were on YouTube stream and I tried to find a low in the NASDAQ, and the first move over here into 880, it failed. Then I tried at 867, it failed. This one was a bad trade. And then finally we caught it at 805, and this thing ran over 120 points. Now, what's the difference between these? How can I catch the knives properly? Realistically, when I'm trying to catch knives, I'm trying to find areas of massive distributions. So key auction extremes of the volume profile that have these massive distributions, as well as prior accumulations of delta that allow me to identify that there's actually active participants in those areas. So even if I have, let's say, 3 areas of massive distributions and I try each one of them just once, there's a pretty high probability that I'm actually going to find that low for a larger expansion to see a buy stop run. Now, a lot of this is dependent on the general expectation of the current market trend. So if we've been trending to the upside for the last few days, there's a high probability you're going to see a buy stop run, especially into the end of the day. Now, instead of just looking at this and saying, okay, well, I just want to start buying at every single key area that I have of a distribution, one of the best things that you could do is actually wait for that distribution area, that key extreme area, to fail, and then move up into that, back into that balance, and then start trying to buy that, because that increases the probability of actually catching that move that reverses. Now, the thing is, a lot of the time there might not be that pullback after the expansion. So a lot of people, what they do is actually they put buy stops above key areas where delta may start, where there is an expected expansion, a buy stop run to catch the expansion of that move. So you can look at it 2 ways, right? Instead of saying, okay, I want to buy this low, this is the expectation of the actual turning point, you can say, okay, let's wait for that to head fake lower, expand back in, then you can do buy stop or wait for the retest to actually catch that knife and look for that massive reversal, which comes from huge distribution areas like we have here. We've got 2 areas, so generally I have 2 expected longs to try, and it's going to be better based on the expansion back above to see if we can actually move back within, run those stops, and move through the aggressive delta that shapes up. So don't go catching knives all the time, right? Trying to constantly fade can get you in trouble if you don't have the risk appetite for it. Instead, maybe wait for that turning point of a failed move and a mean reversion back into the area that you're looking at. So with that in mind, if you want to learn more about these setups and strategies, we have a free PDF down below you guys can check out.